What are the lies when it comes to trading the oscillators as a trader? There are so many lies surrounding the concept of trading the oscillators. Remember, every indicator on your trading platform is for your advantage as a trader. But when this concept has been applied in the wrong way, you will get the wrong result. So there are so many lies surrounding this concept. These oscillators ranging from stochastic oscillator to relative strength index. It can be MACD, it can be a commodity channel index, regardless of any of these that you are using for your trade confirmation. So this lie is particularly relative to when it comes to identifying and trading the concept of overbought and oversold zone. So what that means is that you were told most often that when price is at the level of 80 to 90, you should sell. And when price is at the level of 20 to 10, you should buy. This alone in isolation is a big lie when it comes to trading the financial market, because price did not respect the indicators this way. There are zones where institutions move. So if this concept must work, it must coincide with those institutional area or zone. For instance, looking at this scenario, you realize that here price is at the level of 90 and 10, and here is the same position on the chart. So this is what we have. Following this concept of overbought, you were asked to sell from this zone. So if you could have sold from here, realize that price keep pushing higher. So this is enough to blow your account all the way to this point. You can see now how that lies can be. So why is this a lie? Because looking at what you were told and what we are seeing on the chart now, it did not work out in that exact way. So what is the lie? The lie is that you are trading against the trend, and so this cannot work. So meaning that trading overbought and oversold zone in isolation is not a trading strategy. Here again we'll have another one. Look at price here and look at it here. You were asked to buy, but what happened? Price keeps selling. It did not work. So the system is not designed to function in isolation. There must be other confluence, there must be additional confirmation if you must benefit from this idea. How then? What is the truth about this? Using this indicator is also very much profitable, and if only you apply it in the right way. It has to be applied in the correct way. So there is a right way to do it, and that is what guarantees a good result when it comes to applying it. What is the right way? One of the ways to do it is for you to do what? To identify the trend of the market, which means that you must be willing to trade in the direction of the trend. You are not going to do this in isolation, but in precise direction with the trend. So let's look at this particular movement. Again, look at this. We have this movement, price pull down here and price pull down here. So you bought from here, you realize that price went up a little. And again, let's look at this. Price pulled to this point. Just a moment. So price pulled to this point. This is price here, and this is price here, and then it bought. So why? Because when price is above this middle Bollinger Band, this is an uptrend. So price will testing this moving middle Bollinger Band is the same thing as price retesting the moving average 200. So you see now it bought. It bought because this is not in isolation. Okay, again we have this and we have this. So you see that this bought to the upside. The question is, why did this buy? Because if you look critically, there is a point of interest in that zone. And so here is the point of interest and why price actually bought from this zone. Here you realize that we have an imbalance here. Do you see that? So there is an imbalance in this zone. And because of this imbalance, what happened? Price pulled back to fill in this imbalance, which is our fair value gap. You see that? So price fill it, and then the indicator gave us that signal, and that is why it bought to the upside. So we're having imbalance, we're having the middle Bollinger Band. So this confluence contribute to the buy from that zone. So it wasn't in isolation, it was in an uptrend. There is an imbalance and it bought all the way to the upside. So this is why you can't do this in isolation. Look at this one too. This bought because it is at the level of, not because it is at the level of 20 and 10, but because this is an uptrend. And if you look at this as well, you realize that we have a point of interest. Look at this. There is also a fair value gap. There is an imbalance in that zone. And because there is that imbalance, price obviously did what? Price retest that zone. So look at what happened. Price pulled back to fill in that imbalance. And then afterward, price is at the level of 20 and 10. And then it went to the upside. But if you went to be selling, and because price was at the level of 80 and 90, and you were selling from this zone, price keep pushing to the upside, taking you out, and then you keep blowing your trading account consistently. So if this strategy must work, it must be in line with either your point of interest, which can be your support and resistance. For instance, let me show you something. You see this? All right, this is when it was here. If you should have bought here, you see the price keep pulling to the downside. Do you see that? But look at this scenario. Price was here and this bought and it buy. The question is why? Because this is a support zone. So you can see that this is a typical support zone and it plays out. Why? And this is price came here the first time, price went back, came into that zone again, and then you see that movement to the upside. So these are the secrets behind the overbought and oversold zone. So you don't just jump into buying or jump into selling just like that. There must be a confluence. There must be a confluence. Look at this zone. Let me show you something. So anytime you see price pull down to those zones, so remember this is an uptrend. Okay, price has been in a downtrend. Look at this. This is a lower high and a lower low. So price break structure, and then what you are seeing here now is a pullback. Okay, so if we put a Fibonacci, you realize that this should be at a reasonable level of our Fibonacci retracement tool. So let's go. This is our Fibonacci tool, and let's see what we are having here. So you see that? Perfect. So what do you see? Price pulled back to almost 78.5 of the Fibonacci, and that coincides with this zone, and this is a break of structure to the upside, and then you see it playing out correctly. So these are confluence. These are the right way you can do this. So you don't just gamble it and assume that when price pull back to this zone, it's a buy, I just buy. No, it won't work, and it can never work that way. If it were, look at another scenario, you could have sold here and price still keep pushing higher. So you don't trade this in isolation. It must be traded with additional confluence. Otherwise, you keep blowing your account. Look at this. Price pull down here, you sell here, see price keep pushing to the downside. Okay, so additional whale is as well as using your divergence, and that will be of great help. Look at these two, you would have sold here and price still keep pushing to the downside. You would have sold here, you would have bought here and price keep pushing to the downside. So this is the correct concept. By doing this, you realize that you are maximizing this strategy and you are becoming more and more profitable. Thank you for watching, and I believe you have gained value from this video. If yes, why not hit the subscribe button, turn on your notification bell so you'll be the first to get notified when we upload our next video, and do not forget to give this video a like, share, and see you in the subsequent video.